So, Foot Locker's setup is insanely great going into these earnings.
Woo, man. I could not resist making fun of Jeremy. But you know what? This video is not about Jeremy Lefebvre. I am not going to roast Jeremy Lafufu. I'm sorry. If you want a Lafufu roast, you got to go somewhere else. But I couldn't resist. Anyway, welcome back to Strongman Personal Finance. Let's go over the earnings of Foot Locker because the stock is down like, what, 30% after hours? Absolute destruction, okay? This is why I warn you people about dividend stocks. This is why I warn you people about individual stocks. This is why I think you should probably put most of your money in a total market index fund in a tax advantage account. But what do I know? I'm just a boring guy. So let's talk about Foot Locker. What are some of the highlights? And then we'll dive into the financial statements. And then we'll see how bad it actually is. Total sales decreased 9.9%. Comparable store sales decreased 9.4%. So sales in their stores are down almost 10%. EPS loss, so now they're unprofitable, of 5 cents per share. They're lowering their 2023 sales and earnings guidance. They're pausing their dividend. Oh my God. Now this stock is intrinsically worthless. And they're reiterating commitment to lace up plan. What an absolute disaster. So if we actually go look at their sales in more details, we can see where the big declines are. Champ Sports down 27% year on year. Foot Locker itself down 6%. And Kids Foot Locker up 6%. What an absolute disaster. And most of the losses, most of the decrease in revenue came from North America. This is where the big guns are, okay? Most of their sales are in North America. I would say roughly 70% it looks like, just off the top of my head. What an absolute disaster. Let's go ahead and look at the balance sheet. So I like to look at a couple things on the balance sheet. I like to compare current assets to current liabilities and long-term assets to long-term liabilities. And of course, I like to look at stockholders' equity to see what's going on. So let's compare 2023 to 2022. Cash is down pretty significantly. Inventories are up. So their cash is down and their inventories are increasing. That's worrying. Inventories going up while sales are going down. Are they having trouble clearing stuff? Other current assets, no major change. So they have total current assets of, it looks like, $2.3 billion. Let's compare that to their current debts. So they currently owe $1.5 billion in current liabilities. They have accounts payable, this is accrued expenses they have to pay in the next month or two, of $514 million, and other accrued liabilities of $419 million. That's a little concerning, okay? They don't have a lot of cash. Most of their current assets are in inventory, which is harder to liquidate, especially if you're having trouble churning sales. It's very hard potentially to convert inventories to cash. So currently, they're not in a good position, okay? They're going to have to either hopefully sell a bunch of inventory really quickly, or they're going to have to borrow on credit to meet their short-term obligations, I think. So that's not good. We look at long-term assets. Let's see what they did here. So property, plant, equipment, basically the same, maybe depreciation right there. Operating leases, okay, they've amortized some of those. Basically, a lease, you just owe payments over a certain period of time, and you have to put it on your balance sheet. Deferred taxes, no real change there. Goodwill, no change. So they actually had, looks like a tiny little, cute little acquisition, because whenever goodwill goes up, that means this company, Foot Locker, bought another company. Other intangible assets, nothing really crazy there. Minority investments, that's interesting. It's gone down. Now, depending on how these investments are classified, really determines how it goes down. If they have equity ownership, if they use the equity method of accounting, basically when the businesses they own have a loss, they have to write down the investment. That's generally how it works. So potentially whatever they're invested in could have been suffering some losses. Not very good. Let's compare that to long-term debt. So they have long-term debt of $444 million and long-term lease obligations of $2 billion. So overall, if you compare their long-term debt to their long-term assets, not as bad necessarily because they have more long-term assets that are actually tangible property, plant, equipment than they do long-term debt. So their long-term debt profile isn't the worst. Their total shareholders' equity, which is just assets minus liabilities, is $3.2 billion. So is this company to go bankrupt? Maybe not imminently, but if trends continue, I can definitely see that. I'm definitely concerned about their cash position. I'll tell you that right up front, but it doesn't necessarily mean the death knell. Let's go ahead and look at the statement of cash flows. Negative operating cash flow. Very, very big red flag, okay? Negative operating cash flow means cash flow from their core business is negative. They are burning cash. And you can see, crazy enough, look at the difference between inventory purchases. So in the quarter, July 30th, 2022, for that quarter, they spent $413 million in inventory. They've cut their inventory purchases in half, and they still have worse negative cash flow. That's pretty bad. Okay, so even though they cut down their inventory purchases massively, they still have pretty significant negative operating cash flow. On top of that, they spent $105 million of capital expenditures. If this trend continues, they are going to have to issue more shares or they're going to have to borrow more money. And if this keeps continuing and continuing, they're going to go bankrupt, 100% guaranteed. If your business has negative operating cash flow and you don't have many assets that you can sell off, guess what? You're going to be in trouble. Okay, so I don't know what they plan to do. Maybe they want to shut down some stores. Maybe they want to fire a bunch of people. But stuff is not looking good, okay? Let's go down to financing activity. So they paid, even though they had these tough times, they paid dividends in the last quarter. They suspended it. Good. This is a good thing. You want them to stop paying dividends because they don't have much cash. But they went ahead and still paid out $75 million of dividends. Good job, guys, okay? And they got a little bit of cash flow from stock options. But overall, they used cash in financing. So they used a lot of cash, okay? Basically, I see negative, negative, negative. In order to survive, they're going to have to make this number positive, this financing. They're going to have to borrow money. It's inevitable. If they don't, or sell something, they're in massive freaking trouble. Check out the pinned comment below and join our Discord community where you can ask me questions directly via text. And if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment, join the Discord community, and let's make some money. Now, if you look at the history of Foot Locker, right? You know, their revenue was slowly growing year over year. You know, their gross profit margin was, around 30%. Operating margin, very low operating margins, and very low profit margins. A very small swing in this can result in massive unprofitability. And that's where they're at right now. They are unprofitable, okay? Their operating cash flow, it's not good. It's not good. Nothing is good, okay? Now, here's the problem. I try to warn you people, and you don't listen. If you focus on dividend yield, you're going to get your butt clapped. You're going to get it clapped, and you're going to get it clapped hard. This stock, if you look right here, has supposedly a 9.6% dividend yield. And a lot of people will look at this and say, wow, that's a high dividend yield. They won't know that the dividend got cut. They just stopped it, which is a good thing. They need to stop paying the dividend. And they'll look at the PE and they'll say, wow, the PE is really good. You know, oh my God. And they'll get absolutely wrecked. Okay? So be very careful. When you listen to a guru, you know, they'll speak with confidence. They'll tell you they know something that you don't. You're going to get slaughtered. Okay? Just stop. If you like dividends, buy a freaking broadly diversified ETF with a low expense ratio. Stop buying individual stocks. 28% down. That's a disaster. So overall, let this be a warning to all of you that even great companies, you look at them historically and, oh, their profit margin's this, and if I grow their cash flows by this amount, and then I think their PE is going to be this in 5 years, oh, I can make this much money and get this much return. It's not that simple, okay? If it was that simple where you could just put money into a calculator, then I guess everything money would be millionaires. Well, real millionaires. All their fans would be millionaires. So overall, I'm not touching this freaking turd. There's some very bad things going on. They're going to have to dilute, I think, or they're going to have to borrow insane amounts of money unless there's some kind of turnaround. And it could almost enter the death spiral where the lower the stock price goes, the less money they can raise through share issuance, and the more and more and more hurt they feel. So, sorry if you listen to Jeremy, guys, but maybe you should consider an index fund. Love you, Jeremy. Cheers!